cottages, villas, boathouses, investment properties, and recreational properties. Do you own one? You looking to buy one? Is there a difference? If you want to know, then this video is for you. This is the Commandments of Wealth podcast.
This is Alex.
I'm Joel.
And we are wealth managers from a wealth management firm based out of Toronto, Ontario, Canada, where we serve 6, 7, and 8-figure entrepreneurs and investors Canada-wide, coast to coast.
And we're going to go over some of the insights and strategies that we have implemented for our clients and ourselves to help build, protect, and preserve wealth to the next generation. And today we're going over an article that talks about just that. It's, I guess you can bring up the article as well, but it's a young couple, or not young couple, an older retired couple.
An older young couple.
They would like that we said young.
Yeah, they're older young couple.
But a retired couple, and they're looking to buy a recreational property in retirement. So I guess, Alex, is there even a difference between a recreational property and an investment property?
So, I'll answer that with a bit of a drum roll for suspense.
Yeah.
And the answer is no. So, again, just a little bit of humor here. If I were to go to a barbecue, I go to your barbecue and I have my wife and kids and I say, hey, Joel, for the summer, I'm going to be taking my wife and kids to the investment property this summer, right?
Big ego. We didn't talk to you anymore.
Exactly, right? So for us at a personal level, right, we make a distinction between an investment property and a recreational property because it's how we in our minds are going to be using it. But as far as the government is concerned, they just see it as a primary residence, aka you have no capital gains tax when you sell, or in Canada, or an investment property, which is there's going to be capital gains tax, and there's an expectation that you're going to be getting some kind of value out of it. Because I'd say this is a commandment of wealth right here in and of itself, but an asset is something that either appreciates in value over time or generates revenue while you hold it.
Ideally both,
exactly. Yeah. So the government is already looking at your recreational property as that, because even if you never have a tenant, the value of the property is going to go up.
So it's an investment property no matter what you call it.
Yeah, no matter what you call it, right?
And then in the article, it kind of goes, great. So, you're at a place in your life where you're going to be able to buy, or you're looking to buy a recreational property. I guess they talk about what they're doing here in terms of the impact, right?
Yeah. So what they were talking about, so their scenario was that they owned a primary residence, they owned a condo, they sold their primary residence, moved into their condo so that they could take the tax-free proceeds of the primary residence, and then they used that to then buy their recreational property.
And in the article, they talk about what the impact that you should think about, right? And I guess you can search it while I talk, but
so
they mentioned that, what does that say?
So they're saying that the biggest factors in acquiring a recreational property is not just a question of whether the retiree or the nearly retired can afford to purchase the second property, but also how they want to purchase it.
Okay. And that makes sense too, right? Because if you're taking, let's use $1 million as an example in Canada, the average price of a property, and you're putting into the stock market or any other asset class that gives you a bare minimum of 6%, as an example, that's $60,000 in depreciation. But if you are buying now an actual recreational property, you're going to be living in it for 6 months of the year, you have to look at whether you're going to be able to rent it on the other 6 months or not. Because what you've effectively done is taken a portion of your lifestyle assets, and instead of using it to generate income for your retirement, now you're using it for a lifestyle, right? And as a result, what ends up happening is your income has gone naturally down, and your expenses have gone up.
Yes.
Utility costs, property taxes, etc., upkeep of the property. So your expenses are naturally going to go up. So you want to look at if the property that you're going to be using for joy is viable to support your lifestyle and won't drain your assets that you need for retirement in the next 30, 40 years.
Exactly.
And I guess a good way about it is, like, a lot of people use their recreational properties or their cottages, their villas for a portion of the year, not the whole year, right?
Yeah, typically.
And I know in Canada, it's usually about 6 months, right? We try to escape the winter or enjoy the winter. It's one or the other, right?
Exactly, yeah.
But so let's say, I don't know, what do you think they can rent an investment property or a cottage on a monthly basis?
So I'm saying that if we're going to be conservative, I would say, and this is just kind of keeping in mind, interest rates are on the rise
Yeah.
at the time that we're having this recording. Let's say $3,000 a month.
Okay, so
Right.
$3,000 a month. You times that by they're living in the property for 6 months and they're renting out for 6. That gives you 18,000.
That's correct.
So what you want to do is you want to take the revenue that's generated on a per monthly basis and divide it by the asset value that you paid for. So in this case, it was $1 million.
Exactly.
Right? So if you do that, 18,000 divided by $1 million,
Yep.
you're going to get a yield of 1.8% a year.
Exactly. So
Not a
this-
lot.
yeah.
Imagine if you took that $1 million and you put it into Enbridge. How much is Enbridge paying as a dividend?
So yeah, so if we look at Enbridge right now, Enbridge is paying 6.73%.
So that would pay you $67,000 a year, right? More than the $3,000 a month,
Yeah.
even if it was for half the year. Okay, and what if you did, I don't know, you want a little bit more diversification. If you want
So
to
if
buy
we-
utility,
yeah, the-
ETF, covered call,
Yeah.
solar, wind, natural gas,
Exactly.
electricity distribution,
So you're looking at 7.62%.
so 76 grand.
Yeah.
So you can see the impact is this family is making a decision to take an asset that was worth $1 million that could generate anywhere between $67,000 to $76,000 a year, not including any capital appreciation or depreciation, and help that fund their lifestyle. But what they have done has now, this is the decision they made, is to take the property, take that money, and use it for recreation.
Yes.
Now we don't know the entire situation as family, but it's very obvious that over the long term, if they're not going to be renting out the property for at the same degree, income down,
That's
expenses up.
exactly. So they're taking a hit on their future earnings in order to have an improved lifestyle.
So if you can see and make sure in your plan that this doesn't hamstring your retirement plan over the long term, then go for it. And if you can take a step further and rent out the property for a few months of the year, you're going to be doing yourself a good as well. And then you can actually write off more of the stuff too.
Absolutely. Which is a great segue into the ideal way to structure holding it. So
How you purchase it.
Yeah, how you purchase it, right? So for most Canadians, it's going to be one of these two things, right? It's either going to be, assuming just to keep it even across all situations, that both cases it's a husband and wife, right? So if you have a husband and wife, at a personal level, they would have each other's name on the deed to the property, right? And effectively, because it's going to be considered an investment property, right? If they're not earning any income off of it, it's not going to be as big of a concern, but ideally you would want to be earning income off of it,
There's
right?
still going to be capital appreciation.
It's still going to be capital appreciation, right? So the thing is, there's going to be taxes, of course, that you're going to be paying on the rental income that you are getting, right? And then when you pass away, what would happen is you can defer the taxes on the death of the first spouse. So the taxes at the estate level are only going to have to really be paid when the second spouse passes away.
And then that's when the bill comes due.
That's when the bill comes due, right?
But now what happens if, you want your kids on it?
So if your kid is on the property?
Yeah, like if it's on an individual basis, is it better to do it, putting your kid on the deed as an individual owner? Or is it better to have a corporation or trust and have the children be shareholders along with the spouses?
So great segue. So the other thing that is very common actually for recreational properties is because they're considered investments, it's often well worth it to set up a corporation. And there's several benefits that a corporation has for holding assets like real estate in order to keep it within the bloodline of the family, right?
Bloodline of the family, what do you mean by that?
So what I mean to say is that nowadays we have a lot more commonly, or I should say it's more common nowadays to have more complex family structures, let's put it that way, right? So you could have, two people from, second marriages coming together.
Stepbrothers.
Stepbrothers. So there's, relatives from, or sons, children and daughters from other marriages, things like that. And what might happen is you might have a recreational property where the husband and the wife of the current marriage say, like, we only want our mutually biological children,
Our bloodlines.
our bloodlines to have direct access to this, these properties, right? Whereas
if you had it on an individual basis, this person gets married, and then the son is married to someone else, or the daughter is married to someone else, and these people come in and now they're trying to claim ownership on the family's hard work.
Yeah.
So if you set up a corporation or trust, it would be more beneficial to keep the asset within the family bloodlines.
Yes, absolutely. Right. Now, obviously, this also means that within the corporation, because you're not limited to just the deed at the time the property is being acquired, right?
Yeah.
So with the corporation, you can always, look at adding shareholders. There's different types of shareholders. There's different percentage allocations of shareholders. Much more flexibility. Now, the other big thing is that when it comes to the estate tax part, which is huge, because again, you've spent years enjoying this property. It's a family property. You want to keep it that way. So this big estate tax bill is coming. So this brings us into the use of certain insurance vehicles, strategies, right? Because what's going to happen is with the insurance. So we covered in a previous video in more detail. It's the small business deduction, tax video. I'd recommend that you watch it if you want more details. But for the purpose of this video, what the insurance allows you to do is it allows you to have the necessary amount of funds needed to take care of that estate tax at the end when the the person who would trigger the tax pass away. So in this case, the last parent, right?
So let me get this straight. If you set up a corporation or trust, you increase the probability of the family and their family bloodlines retaining the asset and protecting from any not only creditors but any outside parties. And if you bolt on an insurance component to it, it would be even more tax efficient.
Absolutely, right? So, again, you can just kind of summarizing what we talked about. So with the investment property or the recreational property, right, there's ways that you can rent it out when you're not planning to use it, which is great. Big supporter of that idea. You're generating that income. The insurance vehicle would allow you to make even that form of income more tax efficient
down the
line. When you pass away, you're already going to have the funds necessary to help whoever's supposed to inherit that property ownership in order to pay for the estate taxes in a tax efficient way. And while all of that's being done, you're then able to enjoy this. And of course, because it's an investment property owned by a corporation, you also get the benefit of being able to expense things.
So it's a recreational investment property.
Exactly. Which I think is great at bringing us into our commandment of the day.
Yes, the commandment of wealth is there. Look, if possible, to take profit from your joy and take joy in your profit. So I say again, look, if possible, to take profit from your joy and take joy in your profits. So if you buy a recreational property and you can afford it, and you look out into the future and you're able to take that big asset of $1 million, put it into something else, and still feel comfortable about your retirement, your cash flow, and your expenses, why not take some profit and joy from it at the same time?
Exactly. Couldn't have said it any better, Joel. That's why it's a commandment of wealth. As far as the government's concerned, whether you never plan to make money off it or not is irrelevant.
It's an investment
right?
property.
It's an investment property, right? So you're gonna get joy from this property. Nothing wrong with profiting off of what makes you happy.
There you go. So
right?
articles in the description. Send us a message if you'd like to go more in detail on how some of these strategies to reduce taxes, keep the asset in the family bloodlines. Send us a message. We'd be happy to chat with you guys. Until next time, this is the Commandments of Wealth podcast. I'm Joel.
This is Alex.
Have a good one, guys.
We'll see you next week.
Ciao.
Ciao.